Hey, this is Andres, CEO of Good.Lab, and I'm going to talk about how to measure and manage your emissions. Today, every company is being asked the same question. What is your carbon footprint? Customers, investors, regulators, they all expect accurate answers, supported by data rather than estimates. The expectation has made carbon accounting essential. It is the foundation for credible climate action, and it is helping organizations measure and understand their impacts before they plan to reduce it. So what is carbon accounting? Well, it is the process of quantifying your company's greenhouse gas emissions across three categories: Scope 1, 2, and 3. Let's talk about the scopes. Scope 1 covers direct emissions from owned assets like vehicles, boilers, etc. Scope 2 covers indirect emissions from purchased electricity or energy. And then Scope 3 includes all other indirect emissions, like those from suppliers, transportation, waste, employee travel, and product use. Accurate measurement is critical for several reasons. 1, meeting customer data requests from major buyers. 2, complying with climate disclosure laws such as California SB 219. And you can check out some of our videos on that below. We'll put them in the link in the description. 3, understanding climate-related risks and opportunities. 4, enabling consistent, transparent communication with stakeholders and investors. And 5, building a stronger foundation for long-term emission reduction. The Greenhouse Gas Protocol provides the global standard for calculating emissions. Okay, let's talk a little bit about measuring your emissions and why this is challenging. Carbon accounting can be difficult because relevant data lives in different places of your business: facilities, utilities, logistics, procurement, etc. Each team tracks information in its own way, which makes it hard to see the complete picture. So here's how to solve it. A structured process brings this data together in a single place. A greenhouse gas emission calculator applies verified emission factors to convert activities, ultimately landing you on a carbon emission single data output that you can compare across different sources. Why this matters? Well, this organized approach saves time, it increases accuracy, and it gives every department a shared understanding of the company's carbon footprint. Let's turn data into action. How to interpret these results? Well, once the emissions are calculated, you can review them and you can identify where they come from. You can identify main sources that drive your carbon footprint. You can then plan on some next steps. You can set reduction targets, you can guide investment decisions, you can align reporting with frameworks like TCFD and ISSB. And finally, you can communicate progress to relevant stakeholders.